Welcome everyone to an episode of Trident Talks. I'm Josh, the director here at Trident, and today I'm joined by Logan, who is the founder and CEO of ORNA. Logan, thanks for joining.
Thank you, Josh. It's my pleasure to be here, and thank you for the short intro.
Logan, as we've aforementioned, you're joining us. We're releasing a July series, talking to founders and owners of security kind of vendors and software vendors about investment, trying to kind of bring investment and the discussions that go on behind the scenes and through the shadows and the smoke, and kind of bring it to the kind of to the viewers and listeners who might not know too much about it and what happens until they just get a PR release that comes up and saying, hey, X person's a secured X investment. So firstly, for kind of our listeners and viewers, what do you guys do? What's the purpose of ORNA?
Well, it's what you call a security orchestration automation response, a SOAR platform. And lately this term is evolving into something else called XDR, so extended detection and response, right? Just buzzwords. But ultimately, it's a platform that detects attacks, helps response, does a bunch of integrations with your entire tech stack, so you can coordinate everything in one single spot. A bunch of AI elements and pretty innovative stuff. But ultimately, the point is it's a SOAR platform that is affordably priced for mid-sized businesses. I think it's a tragically underserved segment, as a matter of fact. Large organizations can throw money at this problem, mid-sized businesses not so much.
Totally, 100% agree. So you guys have recently just secured a round of funding. Congratulations. Talk to us kind of at what point did you guys realize, was it right at the kind of the ideation piece where you went, we needed some cash behind this because it's going to be expensive to build a software company? Or like, at what point did you guys all get together and realize, and sorry, just to go back a second, there's 3 founders, right? Correct?
That's right, yes.
Yeah, okay, cool. So at what point did you guys realize, actually, we need to go to kind of the market and get some funding?
So that was always the intention, right? This is my third tech company. So I had 2 successful exits in 13 and 15 with artificial intelligence and robotics companies, respectively. So, you do want to raise money, especially if it's a tech startup, for 2 reasons. So most people think, well, obviously, yeah, your operations need to get funded. That's absolutely true. If you look at the growth trajectories of bootstrapped companies versus, VC-backed or even angel-backed companies, they differ just dramatically, right? I mean, it's by a factor of 10 to 20, right? So absolutely, there's no question getting funded is massively helpful for growth. Right, and every founder wants to go to that unicorn status, so you got to raise some funds. But secondly, that really sets you up for subsequent fundraisers. So you get seed, right? Some companies raise pre-seed. That's like they have an idea. It's not that common actually. Yeah, but pre-seed is investors need a lot of trust in your idea, first of all, and secondly, that usually causes massive dilution because they have to compensate for the risk at this stage. So seed level is like you have a prototype, you're kind of on the market usually. Then there's Series A, where looking maybe like between $5 and $10 million kind of revenue. You got proper product market fit. And then there's Series B, C, and so on, right? So raising money this early sets you up pretty well for Series A because you're able to demonstrate, in practical terms, ironclad returns on investment for your seed stage investors, right? And at Series A, the risk is significantly lower, so that's a strong incentive for investors, both of that round and new investors, to put in more capital in this company.
Yeah, that's awesome. Yeah, thank you. So how did you get there? So you've just raised, I think it's public, right? Just over £1 million, $1.5 million. Is that right?
Oh no! So we've been asking for 1 million, and we ended up oversubscribing.
Nice.
So we ended up raising 1,065,000, and we had a bunch of other offers, you would call them, on the table, which we had to decline to again avoid dilution.
Of course. So how do you get there? So obviously, your background, you're very fortunate, and again, congratulations on the other 2 exits. You've got that network, you've got that. I'm sure you can just reach out to people in the past, right? That you can go, hey, I'm now back on the market for more investment. I've got this new idea. This is what it is. This is the plan. So is that kind of how you do it? You put your deck together, you put your business plan together. You've got obviously the 2 other founders, and you just go start pitching to the market and getting your word out there that you're looking for funding.
Pretty much, yes. So some people think, so I want to address this whole business plan thing. So business plan is not necessarily, people, especially like MBAs, for example, they tend to think, oh, well, we must have a business plan. It needs to be like a 60-page document that's incredibly detailed. So, and I'm a like I keep it real, I tend to keep it real. So any kind of business plan you're going to put at the seed to pre-seed stage for a company is going to be total BS. Okay. So you know it, investors know it, a bunch of other people know it. There are going to be major deviations from that. Your projections are accurate, maybe to the factor of 30 to 50% at best, right? So, stuff like that. So it's basically more or less a pointless exercise. So that's not to say you should go to business without a business plan, but it doesn't need to be one super long, PDF document. It just basically needs to show that, yeah, you know what you're doing, the challenge, you're addressing it in a correct way, who your, ICP, so it's ideal customer profile, or some people say TA, target audience, is, you're solid on the pricing, you've done competitive analysis. And please, for God's sake, don't say, if you're listening to this, do not say we have no competitors in your deck. You have competitors, okay? There's no question. You have some kind of competitors, whether direct, indirect, there's something going on. If there are no competitors at all, there's likely no market for your product. So, you might want to pivot. So things like that. Definitely want to focus on returns, and you want to provide some risk mitigating factors. At this early stage, typically investors look at the team. So one of their primary considerations is is this the right team to deliver on this vision, right? So you want to emphasize why and how. Does it have to be your team to do it? And like I said, product market fit, i.e., what the problem is, it's ironclad. Your solution does address it in the direct way. So does it fit? So that kind of stuff. Yeah. But, the deck shouldn't be too long, maybe 10, 15 slides. Otherwise people get bored. The approach we used is we have a one-pager summary. So we'd send it ahead of time. And then if the investor is interested, then we would schedule a meeting to go over the full deck. Right after that, we would shoot them an email with access to the data room we have. So data room is just a collection of all kinds of materials about the business and corporation documents, employment contracts, financial projections, maybe some intellectual property stuff, right? Sort of like a package. The vehicle that we've used to raise funds, I don't know if this is part of this question, so stop me, so it's called a convertible note, right? So this is something that's worth exploring, because there are basically two types of raises you can do. You can do an equity raise, which means investors are directly purchasing shares at your company. And there's a non-dilutive raise, basically, or non-equity raise. Typically, there are many types of it. They're like safe notes, convertible notes, all kinds of stuff. But ultimately, it's I'm just thinking how to explain this real quickly. But basically, that's when investors give you money based on your future valuation of the company that's capped at a certain amount. That's called, for example, a convertible note cap. And to incentivize them further, you usually offer them some kind of discount on a price per share basis. And you set a term for their investment on a convertible note. So once the term expires, and I'll give an example for all of this, then the investors usually either have a choice, or maybe your agreement stipulates a default condition, but either that investment converts into shares based on that cap plus discount, or if they are not so happy with your company's performance, they can choose to get it converted into debt, which then, it's just debt, right? So with a certain interest point. Yeah. So for example, let's say you're going on a convertible note, you could choose to raise, let's say $1 million, let's say 15-month term, 6% interest, and something like a 20% discount, right? So that means, you have 15 months to reach whatever goals you promised to your investors. And then you're going to say, look, you have a $15 million cap, valuation cap, and at that cap, your investment is going to convert into equity. So lastly, what does that mean, right? So you're going to have to do evaluation at that point. Let's say you do evaluation, your company is valued at $100 million. Okay, maybe you've been growing very quickly. But for your investors, their investment is going to convert into shares as if your company's valuation was $15 million. So that's a massive discount, and it's a really strong incentive. And it's very, very common to do this. It is very difficult to properly value a company on an equity basis at this early stage. So I don't see a lot of pre-seed, seed startups doing an equity raise. Convertible note or safe note, which is basically a simplified convertible note, are much, much more common and quicker, less paperwork.
Yeah, and then it's good once you get your head around that, you can understand why companies choose the convertible notes at that stage.
Absolutely.
We've sat in a few pitches recently with cybersecurity vendors, and a lot of them were going down the convertible note route, and it makes total sense.
It's just quicker too.
Exactly. What's the purpose of you guys raising this money? So you already identified I need the funds. Obviously, your past experience tells you that straight away anyway. But what are you doing with the funds?
Yeah, so we have a very clear, breakdown of the fundraise, which also I recommend including in your presentation to investors, because otherwise they will ask that question anyway. So we're going aggressive on investment into marketing. So 43% of this round is going directly into marketing, and we're going to keep that investment proportionate, more or less, to future round sizes. And again, that's going to fuel hopefully quick growth, right? So that's 43%, and about 20% is going towards product engineering and development, and then the rest of it is primarily operations and legal and that sort of thing. With that being said, we're also profitable right off the bat, so
Nice.
already passed $1 million in revenue, which is nice. So essentially, that also fuels further growth by combining it with the investment amount.
Nice. That's very quick in terms of revenue. Very, very quick. Is this a myth, or we hear this all the time, that VCs, private equities, family offices, for example, don't want you to make a profit in the first couple of years because that means you're not growing quick enough?
They're prepared for you to not make a profit. I wouldn't say they don't want you to make a profit. Look, profits are good, right? So essentially the argument could be, if you have profits, then you're not reinvesting them, correctly.
Yeah, that's what I meant.
Into your company. Yeah. So, some might say that, but then on the other hand, your counter argument to that would be, well, from a risk mitigation standpoint, you want to maintain like at least 6 to 8 months, well, depending on your sales cycle. I mean, this could vary massively, but just like sort of like as a rule of thumb, 6 to 8 months of cash flow in the bank, right? So that's a bit of like a financial cushion. Excessive cash is not always a bad thing. Like it's sometimes accepted by people. Oh, like having cash sit in an account is not the right strategy. But well, you might be positioning yourself for an acquisition, i.e., acquiring somebody else. Right? So you need cash, even for a leverage buyout. You need some kind of cash as a down payment. You do increase. You decrease your operational risk. You increase your investors' confidence in hopefully the assumption that you're not going to go out of business because you're going to spend all the money. So really, it varies, but also the seed stage, you're not going to see a lot of VC interest. There's some micro VCs and very early stage VCs, but it's much more common and much more likely that your seed round is going to be mostly comprised of angel investors. Or angel groups.
Okay. Yeah, fair enough. Just a final question, Logan. I know you're a busy man. Did you have any concerns when you took investment, or are there kind of general concerns as to different rounds that you've ever been through, or particularly with ORNA now, just generally, or is it when you're choosing what type of investor to go with, or?
So yeah, we've been, you want to look for an investor typically that either has, some synergistic businesses in their portfolio, or has an equivalent quality network or an experience investing in similar companies and so on, because this way they can be an active investor that can actually help you grow, help introduce you to connections and so on. You don't want something you might refer to as dumb money, right? They just give you a check and hope for the best. And obviously, look, again, advice for founders: don't just always blindly accept. Like, I know you can be pretty desperate sometimes as a young founder. Like, you do have the money, but for God's sake, don't accept money from difficult people, right? Like, if you talking to the investor and then you hang up, and every time after the call you're like, oh my God, this guy, right? Like, do not accept this investment seriously. Like, you're gonna burn through it, and then it's gonna get really, really bad. So yeah, always try to take a look at what kind of person or people they are to work with. You want to build like a nice ecosystem.
Yeah, good advice. Logan, thank you very much for your time. Good luck with the rest of this year with ORNA. Obviously, you're already killing it. If you're already breaking even, it depends how high your standards are. So I'm sure you want to keep going. Appreciate the insights, your time as well, just to talk about it, give some advice to other future founders as well. And see you around.
Thanks, Josh. It's a pleasure to be here, and good luck to everybody.
Thanks, man.